So how many of y'all remember the segment on Saturday Night Live that was entitled Deep Thoughts by Jack Handey? Well, we've got some deep thoughts for you today, probably not nearly as entertaining as the Jack Handey version, but you're stuck with the Joel Garris version, I guess, on Sunday morning. We're not Saturday Night Live. We're coming to you here on Sunday morning. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out there. Subscribe to us on any of our social media or podcast channels. If you have trouble finding out where exactly our channel is, just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, a bunch of different icons. Click on the one that looks most familiar to you and you'll get immediately connected to us. So make sure you subscribe to us through those various channels. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So we'll get right into sort of our version of the Jack Handey Deep Thoughts. We've got some different things, some different stats that we saw about the markets, about real estate, about the federal debt that we want to kind of share with you and help draw some conclusions on some of the data that we see out there. So without further ado, we'll go straight to the markets. And this is one we've talked a little bit about before, but it does bear repeating. More new brokerage accounts, about 10 million, were opened in the year 2020 than in any other year. Obviously, with the pandemic trapping everybody at home, people were bored. The absence of sports for many months there, people again looking for something to do that might be a little exciting. Enter in these online trading brokerage online apps that are available out there, things like Robinhood, and then you also then have the social media component through the folks at like Reddit, and layer in on top of that, and this last piece is a very important piece, a market that has been going up steadily for nearly 12 months with no real volatility to the downside. You take that perfect combination and you wind up having a lot of bored people, a lot of people thinking the market only goes up. It doesn't, folks. Watch, volatility is normal here. And ultimately looking for something to do, which led to a huge amount of online trading accounts being open. The silver lining on that, and we hope that there is a silver lining on that, is that means that more people may be interested in investing, and we think that that is fantastic. Our fear is that what many folks are doing on Robinhood and the like is not really investing. It's really more speculative trading or just straight trading, and there's a big difference, and we've talked about this in prior shows, between investing and trading. We want folks to be investors, not traders. Being an investor is how ultimately you accumulate wealth over time. So the question also that raises is, the last time we saw this much of an increase in trading, this huge increase, it was the late 90s, where you had the first wave of the phenomenon of day trading. And so you have to think, okay, are we starting to see some parallels to sort of what went on? Because if you layer onto that the fact that there's a small handful of companies, the FANGs, that ultimately are driving like 80% of the performance of the market, and that's where a lot of this activity on these trading accounts that have all been opened up over the course of the past year, that's where a lot of the activity is. So is there perhaps a potential for history to repeat itself? That's perhaps one of our concerns in terms of where the market is and what's happening out there in the world at large, particularly when you consider this next statistic, which is the use of margin debt on the New York Stock Exchange increased to an all-time record of $722 billion. Now, let me explain what margin debt is. That's when you want to buy something, you don't have enough money to buy it, and you borrow money to do so. Stop and think about that. If that was a package of gum, it would be a really bad idea. But for some reason, when it's a stock, it's an okay idea? Question mark? I don't think so. And so anytime you see margin debt, people borrowing money to buy stocks and options and all that kind of stuff, the reality is that that means that more and more people are borrowing money. There's a greater likelihood that there's some kind of a reconciliation ahead of all of that, particularly when the activity is concentrated in a handful of companies. So somewhat concerned about how much debt is out there, and particularly how much debt is out there in the hands of investors as they're borrowing money to make these purchases and these trades on these various apps. So be a little careful with that one, that is for sure. And then lastly, in terms of the markets, before we get to sort of the investor takeaways on this data, it is just how thin the markets are in terms of performance. If you look at the S&P 500, and we just look back to sort of the end of January, was hitting all-time highs at that point. So you got the S&P 500, 500 different companies hitting an all-time high, but if you peel back the layer of the onion, if you will, only 13 companies in the S&P 500, 13 out of 500 were hitting all-time highs simultaneously with the index itself. That to us says that's a pretty thin in terms of the breadth of what's going on in the market relative to what's going on an individual company basis. We'll say that statistic again. 13 companies out of the 500 were hitting highs at the point in time when the index was hitting highs. You'd like to see a little bit more breadth than that in the overall market. So what are some investor takeaways? Well, number one, be careful. Okay, there's a lot of interest in the market right there. If everybody's doing it, it's time to be cautious, right? Warren Buffett's got the expression: be greedy when folks are fearful. Be fearful when everybody is greedy. We may be kind of getting into that latter period of time, particularly when you kind of look at these debt levels, these increase in the amount of accounts, and ultimately just kind of how thin the market is. And so that gives us to the next sort of investor point, which is understand. If performance is concentrated in a few stocks, take a deep dive on your own individual portfolio to make sure that you don't have a high concentration in a small handful of companies. You really got to kind of do an analysis on your various investments across the board. That's one of the reasons why early in the program we were talking about we look at our clients' allocation in their 401ks and make sure that it is working in harmony with whatever it is that we're doing on our end. And the reason for that is that you don't want to see concentration among a handful of companies, because that undermines the diversification, and it also, I think, subjects you to much higher level of concentration in these small handful of names that have really been driving the market of late. So take a deep dive, actually look at the companies that you own and the percentages that your portfolio is in each individual company. If it starts to get above 3% in any one single company, then we would urge you to kind of start that process of maybe rethinking or rebalancing across the board. So next up, we'll shift slightly to what's going on in real estate. Got some interesting stats on that as well. Clearly a seller's market out there, considering the following statistics. As of year end, there was slightly over 1 million homes for sale at year end. 2 years ago, that number at the end of 2018, a total of over 1.5 million homes for sale at that point. And then if we go back just 10 years ago, you would find 3 million homes for sale. That's 3 times the amount of inventory versus what we have now. So fundamental laws of supply and demand, right? The reality is when you've got low supply, even the same level of demand is going to cause prices to go up on a regular basis. And then the next statistic, well, hold on for that one on the real estate side of things. We're going to take a break. When we get back from the break, we're going to hit the next statistic that we've got on real estate and give you some key takeaways for folks to be considering on that. So we'll take a break and then return here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.